Big bank stocks are in focus today after JP Morgan and Morgan Stanley both reported very disappointing second quarter earnings. JP Morgan added that it will now suspend stock buybacks. Joining us to discuss this, Hennessy large cap financial fund portfolio manager David Ellison. David, your early take here. The market is not liking these results. Big earnings misses, a suspended buyback plan. I would say some bearish commentary from JP Morgan CEO Jamie Dimon on the call right now.
Yeah, well, I think he had that last time too. You know, the weatherman, last time there was going to be a hurricane and then there was a tornado or whatever it was. So I think he's been pretty consistent. It hasn't shown up, meaning that non-performers haven't really risen a lot. They haven't had a lot of losses. But I think the trouble's ahead of us, but that's the opportunity for the investors. It's been a very difficult group to make money in because nothing has gone wrong. It's been reasonably good for a number of years coming out of the pandemic, and now we're entering a time when we're finally getting some disruptions. And so the better managements are going to be the ones you want to own and the safer plays. So, I think there's just a lot going on here. I mean, it's amazing how the yield curve has just twisted itself up in the last 2 weeks, and that's obviously a potentially big negative for the space.
Is JP Morgan still the better management, right? For a long time, no one even questioned that notion. Is it time to question it a little more heavily?
Well, no, I don't think so. The question is the businesses that they're in. I mean, the problem we're having now is, while the basic banking of making loans and taking deposits is good, the Wall Street income has become very challenged here. Obviously, this quarter was very bad in most of those spaces, even including asset management, and Morgan Stanley showed you that as well. But if that continues, and I don't see how Wall Street gets a lot better here with the Fed pushing on inflation, the yield curve twisted around, the bigger banks are more internationally exposed, and that's where some of the real problems may show up. The dollar has messed up international commerce and international values, and that's what they're exposed to. So there's going to be some rough times ahead, but that's the opportunity for the shareholders like me, meaning that I can take advantage of this, buy them when everybody kind of gets scared. And that's the Bear Stearns event, right? You made all your money coming out of Bear Stearns and coming out of the financial crisis because you bought them when, things bottomed out. And so here we've had a very good environment for many years. It's now deteriorating because of inflation and the Fed and the yield curve and whatever else you want to throw out there. And that's the opportunity in front of us, in the next couple of years for this space.
So, David, are you a buyer on weakness here? Both these names.
I own both of them. I'm not going to buy them. I'm going to wait. I'm hoping things get worse. I know that's kind of the crazy thing to say.
Do you see things getting worse?
I think conditions will deteriorate further. Yes, credit will deteriorate. The yield curve will create problems. I think deposit outflows will be a problem for them. They've had, obviously, this is the whole industry, massive inflows of deposits. That will start to come down. That will put pressure on their cost of funds. And again, that's all good. I've made most of my money in this space, and you build wealth in this space when things are difficult. And they're just going to be difficult, and that's good for us. So if you're thinking about buying bank stocks, start looking now. The last 3 years have been a waste of time.
Right, but you want to wait a little bit. It sounds like looking at these names and some of the others you like, what for you is the one that you are most chomping at the bit to get in on when it goes down? Is it one of these two, or is there another in the financials that you think is even going to do better when things start to turn?
Yeah, that's a tough call. I think that, I think the mid regionals, the key corps, the fifth thirds, those are all ones you can play too. So this group tends to trade together. They all kind of get scared together and they all get better together. And so I think it's really a question of, it's hard to tell how bad Wall Street's going to be for how long. It's hard to tell what the strong dollar and rates are going to do to international markets. You remember, Citicorp, like, for example, Citicorp got beat up when we went to war or Russia went to war because they had all this international exposure. So if Europe gets into trouble, you're going to find out who has international exposure over there. So I think you just kind of wait it out. I think it's hard to know right now how bad these conditions are going to get and who's going to get impacted. So we'll see. It's the old classic, the tide is going out. people are afraid, but this is where the opportunity is, and today's a good example of that.
David, great reminder for long-term investors here. David Ellison, Hennessy Large Cap Financial Fund. Thank you so much. Appreciate it.